Let's discuss and debate. Now to our panel. Treasury Partners Richard Saperstein, BNY Wealth's Alicia Levine, and Schwab's Kevin Gordon. It's good to have everybody here. What do you think? Is this one of the best tapes you've ever seen?
Well, I can't remember how long I've been doing this, but it's a very good tape. Look, last week's blowout earnings really reinforced one of our long-term themes, which is cloud demand exceeds supply and will continue to exceed supply for at least another year, year and a half. Secondly, there's questions about the return on this cloud investment, the capex, the large amounts. If you look at operating earnings, funds from operations, which we call OCF, and look at it over the next 12 months for the large hyperscalers, Amazon, Google, and
Microsoft,
yeah, slipped there. Okay,
all right.
They're expected to generate 210 to 200, and yeah, that's Google. Okay, 210 to 250 billion dollars in operating cash flow next year. If you go back 3 years and look at what they were generating, it's up anywhere from 110 to 140% in 3 years. So if we're looking for a return on that massive capex investment, look at the operating cash flows. They're growing dramatically. And that's what we should be focusing on as a return on that massive capex investment.
But this commentary that I mentioned on Halftime Report today from Scott Rubner of Citadel Securities, I thought was an important note to discuss. Early summer excesses have largely been unwound. Quote, "We believe much of the global technical reset is behind us. Importantly, the reset occurred through rotation, deleveraging, and stronger fundamentals, not through a deterioration in the macroeconomic backdrop. July did not change the structural bull market. It reset it." Does that make sense? Is that right?
It does, because the economy is fundamentally strong. Manufacturing is strong. Data center build-out is affecting and improving the real economy. Employment is strong. The Fed, whether on hold or tighten, even if they tighten, will be net positive for stocks and bonds. And it's going to leach through towards earnings. And earnings are what's going to drive the S&P. So even though there's rotation like that, in the long run, as we have a strong economy and we have a strong business condition, we're going to get rising earnings, and that's where the market's going to go.
They appreciated the broadening, but you haven't really wanted to lean into it. You've been advocating for almost every conversation that we've had for the foreseeable, past, that this was the trade to continue to lean in on. And you're not changing. I don't sense that from your commentary already in any way, shape, or form.
Correct. We're focused on the large cap hyperscalers and the beneficiaries of the build-out. So we're looking in the concentric rings of the hyperscaler capex and who's the beneficiaries. In addition, we think banks are very strong to own right now. There's a lot of fundamental reasons to own them. Always having some oil in the portfolio is a very sound geopolitical hedge right now. And also, when you look outside tech and you look at price earnings to growth ratios, PEG ratios outside of tech are much higher than technology. So it's really hard to continue to diversify to pay out for lower growth rates. That's why we're really focused on, the technology trade right now.
Do you